Thank you to everyone for attending this morning. We're delighted to have you at Aspire. For those of you who don't know me, I'm Greg Hex, CEO at Chapman Hex here in Dallas. And we're so delighted that you get up early this morning and come and listen and participate and spend a little time networking and stuff. We really appreciate the number of people that show up on a regular basis. With the firm having been around 28 years, we're probably delighted to see all the faces that we've known. And I laugh about all the long-term relationships that we've had as a firm, and so we really appreciate those of you who've worked with us for years. Just as a reminder too, and you'll hear me say this every time you're around me, we're always looking for clients. We're always looking for people we can help. Our clients are mainly businesses and companies that are 20 million to 500 million, because of the variety of services. And I laugh at two people. We're very upfront that we're a different business model than what you're going to see, in that we have figured out how to put a CPA firm, investment banking, and wealth management together and make that work as a one-stop shop for the business owner that's looking for help with growth, capital, financial reporting, lending issues, tax planning, succession planning. That's the world we operate in every day, and so it's a lot of fun, and we enjoy solving problems. So if we can ever help or be a resource, please let us know. A couple of things. There are some different handouts that are sitting in front of you today. There's a CPE evaluation form and also an Aspire evaluation form. And if you'll please fill those out and return them at the desk on the way out today, we'd appreciate that. There's also a handout from Bernstein that'll go along with the presentation. Now, handouts and videos of prior sessions, just as a reminder, are available on the Chapman Hicks website. If you're interested, we keep a video vault up there that you can go, and we break these presentations down in 15-minute increments so that you're able to see pieces of it or look for what you wanted to hear or see. Also, if you want to share those or you want copies or something, let us know. We're more than glad to do that, even copies of the presentations and stuff. We go through a very specific, because we are FINRA SEC broker-dealer, and we understand just as these guys, the world we all live in, and of course we have peer review, peekaboo, everybody else who wants to look at us in the world. We are very conscious of making sure that all the correct things are done to be able to supply you with information from a regulatory viewpoint. So please don't hesitate to ask, but we're delighted to do that. The other thing that you have today is some information in front of you from Children's Hunger Fund. Over the last couple of Aspires, we started this year with the idea that we were going to introduce to you just a quick 5-minute blurb or so about some charity or some 501c3 that we thought you needed to know something about in the Dallas area. When you get out and you start looking on I won't call it National Giving Day, but on North Texas Giving Day, there are 3,400 charities, and so we're trying to spotlight some of those that we think are important. I've had a chance to get to know Children's Hunger Fund because my sister has sat on their national board for a number of years, and have had a chance to go out to California and spend some time with Dave Phillips, the president and founder. And Rusty is here today with us to talk a few minutes about them. They have just moved into the Dallas market in terms of opening a facility, and they have a very unique process that they go through. So come on up and let's talk just a minute about Children's Hunger Fund.
Thanks, Greg. Appreciate it. Appreciate the time this morning to share with you some exciting things that are going on in the Dallas and North Texas area. Children's Hunger Fund is a 26-year-old nonprofit based out of LA. We have facilities in Chicago, Dallas, and San Antonio. Our facility here in Dallas is at 635 and 35, so not too terribly far from here. And it's our mission to deliver hope to suffering children. And we do that by working with local gospel-centered churches. And we train them to go out and do home delivery of food packs. And we put the food packs together. It's a 20-pound box of shelf-stable food. And we train the church members and the church to go do home delivery so that they can help assess the need of why this family is in a poverty situation. And so help resource them to get them out of that situation. But ultimately for us, it's really about spiritual poverty. And so we help train to address that as well. And we do that free of charge to the churches. Churches don't have to pay for the food. But we've got generous support from the corporate world. We get all kinds of donations from some of the largest companies in the world as far as gifts in kind and those kinds of things. So we're always looking for that kind of help, as well as just folks who see the model of getting people out in their community to be on the doorsteps of those in need and to help those in need. And so we have a great base here. We just moved into the Dallas area within the last 2 years. In fact, we're celebrating our 2-year anniversary coming up on May 19th. So you're invited to come by our facility on May 19th from 9 to 12. And I'll have some information out on the table that will have the address and everything. So feel free to come by. We also have a golf tournament coming up at Pebble Beach to help raise some funds for us. So if you're interested in playing golf at Pebble, come see me. We'll see if I can get you hooked up for that. But we just finished up a golf tournament here locally a couple weeks ago, so sorry missed out. But maybe next time. So I'll be leaving a couple of packets out on the table there. They'll look like this. There'll be some out there. And as well, there'll be some flyers for a summer program. As many of you know, in North Texas, hopefully you know, that 3 out of 4 kids in North Texas are food insecure, which is a surprise to many. So 75% of kids are food insecure, which means they don't know where their next meal is coming from. And if it weren't for school, many of these kids would not have food at all. And so during the summer, we're helping to raise meals for kids. So there's some flyers for Summer of Hope. If you'd like to help deliver hope to kids this summer by helping provide some meals, or know some folks, whether it's a church or another organization that you're affiliated with, we'd love to talk to them about how they can help kids this summer have hope for food and beyond.
How many meals did you guys give away worldwide last year?
Last year it was 45 million. Wow.
Yeah, 45 million. And one of the really cool things they do that he alluded to was they distribute through churches worldwide, and that's how the food packs get out. So they never end up out in the black market or somewhere. They go directly to families in need, no matter where it is. They came to Dallas. I don't know how many of you have seen the research that was published in the last day or so about the differential and the issues with income and poverty and what's going on. And you know, it's consistently been said that 20% of the children in Dallas don't get to eat dinner each night. And that just breaks Kim and I's heart. And so we wanted you to hear about this. I can tell you from personal experience, we vetted them, we know them, and you can be comfortable with them. And that's the reason we wanted to show you, what was going on and expose you to it. So please grab some of the information. If you're interested, let us know. Yes?
Do you have any additional events here locally throughout the year?
Oh, we do. We have a dinner coming up. Besides the reception that we're doing on the 19th, we have a dinner coming up on October the 12th, I believe it is. I'll have to verify the date. I had that before you leave today. So obviously you're welcome to that, and invite anyone that you want to come to that. And in that time, we'll also talk more about what we do locally as well as internationally. We're in 27 developing countries, but we do it with very lean staff. We're very volunteer reliant. 97% of all the resources that come in actually go out to the ones we're serving.
And you use corporate groups to pack your boxes and
We do.
that kind of stuff. So if your company's interested in doing something as a group, there's always opportunities to go do this. Their warehouse, as he said, is over at basically Luna Road, 35 and 635. So it's a great kind of middle area for people to get to. Great thing to use. Thank you so much.
Thank you. Appreciate it.
Greg, I think you had another question.
Oh, yes.
I will. I'll be here for the other.
All right. Well, thank you so much. I now get to introduce our speakers today. We're Dan Corello and Greg Young. We're going to have both of them from Bernstein today. First speaker is Dan. He's a VP at Bernstein's Private Wealth Management Office here in Dallas. He's had over a decade of industry experience advising successful individuals regarding their investment strategy. Our other speaker, Greg Young, is a senior portfolio manager and senior VP in Dallas office of Bernstein. And he's a member of Bernstein's Private Client Investment Policy Group. They provide asset allocation, investment, and risk management advice for high net worth clients, endowments, and foundations. And this morning, they're going to talk to us about a 2018 capital markets update and basically what the investor's dilemma really is in today's market. So please help me welcome Dan and Greg.
grab this here. Good morning. Did you know that baby boomers are likely to spend 1.5 times more on medical expenses than they have saved for the entirety of their retirement? Think about that. The average baby boomer has less than $300,000 saved for retirement, and about 30% haven't saved anything for retirement at all. This is a big problem. A lot of people in this room have probably heard about it. It's been addressed for years. And it's not what I'm here to talk about today. I'm here to talk about another problem that no one's really talking about, but it's going to affect all investors. We're not predicting another great recession, so you can get that off the top of your heads. But we do see another problem. So let's take a look at a different example. Let's say you and your spouse have actually done a very good job at saving for retirement. And you've put away money in your 401ks, your IRAs, other investment accounts, and you have compiled a nest egg of about $3 million. And you want to just continue living life, spending what you've been spending before retirement. Let's just say that's about $125,000 in this case, or about $10,000 a month. In a 50-50 conservative, moderately conservative portfolio, 50% bonds, 50% stocks, Bernstein gives you a 50% odds of meeting your lifetime spending needs. So again, this problem is not affecting just people that haven't saved or haven't done a great job saving. It's going to affect people of all scales reaching their financial goals. And what I'm really talking about is we see in the future, the next 10, 20 years, stock markets and bond markets returning significantly less than what we've seen over the history of the stock market, the history of the bond market, and especially over the last 10 years. So good morning. As Greg mentioned, my name is Daniel Corello. I'm a vice president in Bernstein's private client group here in Dallas. I work with a team of 7 advisors. We manage about $4.5 billion locally here. And today I just wanted to go over an intro on Bernstein, tell you who we are, a little bit about why we're different, define that problem, lower returns and higher volatility. Then we're going to have Greg Young come up and give an economic update and talk about this problem a little more. And then finally, provide a few solutions on where we think you can close that return gap. So in a world where most investment managers look alike, Bernstein's private wealth management has evolved into an organization unlike any other. We have the resources of the largest global firms. We have a global presence, 47 cities across 21 countries. But we service our clients like a boutique. It's been something that we have done for over 50 years, and acting as fiduciaries. One thing that's interesting about us is we are very focused and our goals completely align with our clients. 100% of our revenues come from 2 things: investment management and investment research. We're not a bank, we're not an insurance company. We're strictly focused on the investment management and investment research and giving the best possible advice to our clients. So let's dive in a little more into the research here. We do all different kinds of research. We're known for our sell-side research, our industry research, our economic and market research. And before I get into that, there's another research group that many people don't know unless you're a private client. We have what's called a wealth strategies group. And this is comprised of CPAs, attorneys, investment bankers, private equity professionals. And their sole job is to think about all the problems that our clients and our professional contacts are having on a daily basis and kind of sift through the minutia and provide real life solutions for our clients and their clients as well. In terms of research, we are recognized by our peers as being the #1 research group in the world. We have been ranked #1 quality research for 13 consecutive years, and have a host of all other research-related awards, as you can see here. And our investment management is largely the same expertise. So our investment management really combines traditional expertise with outside-the-box thinking. And you can see in the middle of this chart, right, or this page right here, some of our investment management awards. And you might be asking, okay, well, what's the purest expression of your research insights? And that's really in our what we call our targeted services. This is an investment platform that we've developed since 2009 that now totals $30 billion between thematic, opportunistic, and private capital investments for our clients. So I just listed out some examples here. In the thematic private capital space, we see there's a lot of opportunity. Being in Texas, it's probably hit home for some of you. In the energy space, specifically, we are investing in private middle market E&P companies all across the capital spectrum. Middle market lending. We have a large middle market lending group that's based out of Austin, Texas, that's providing loans to private businesses all throughout the country. Real estate, we do two different things here. We do some direct owner operating as well as commercial real estate lending. On the opportunistic side, these are things that are a little more either finite in time or an opportunity where we see out there in the market where we take a team and put a team in place based off what our researchers have found in terms of market dislocation. So examples here, we see a lot of opportunity in the micro cap or regional bank space. There's been a lot of consolidation there for really the last 30 years. We expect that trend to continue. Another one example here is our Next 50. Next 50 is investing in infrastructure and consumer expansion in the next 50 emerging market countries. And we're actually partnered with the World Bank Group on this. So it's a pretty interesting opportunity. And essentially the next 50 is, think of Brazil, India, 30 years ago. That's the countries that we're really looking to build out with our investments. So let's get back to the problem. And this chart really defines the equity portion of this problem. And I want you to focus right now on the left-hand side. And you'll see there the three characteristics that make up stock market returns: dividends, earnings growth, and valuations. So we think we have a pretty good handle on dividends. Dividends for the last 20 years have averaged in the U.S. markets right around 2%. And internationally, it's been hovering about 2 to 3. We think that's probably likely to continue moving forward for the next, again, 10, 20 years. So we have a pretty good estimate of what dividends will be, and we think that'll be 2%. Earnings growth. This has been a topic that's been hot lately. Last year was a fantastic year for companies in the United States. Really good earnings growth. This year is the same thing. We think this will be the best earnings growth in the last 10, 15 years. Next year, we think that trend's going to continue and have another great year for companies in terms of their earnings. But after that, the tax cuts that we're seeing is probably going to work its way through the system, and that earnings growth is really going to normalize. The last thing, valuations, or that you could think of that as your multiples, what people are willing to pay for the dividends and the earnings growth. This is where we see the problem. And that's largely due to low interest rates, rising inflation. We have large deficits predicted for the next decade, a large amount of debt, not only here, but around the globe. Those are the things that really factor into the valuations. And we actually see, instead of a multiple expansion, we see a multiple detraction. So at the end of the day, when you add that up, what does that look like? We think in the United States, it's about a 6% return for equities, and globally, somewhere between 6.5 and 7. So again, this is substantially less than what we've seen over the last 10 years. And the history of, just to give you some reference, the history of the S&P, it's annualized at 10% annually. So it's a 40% drop in terms of what we're expecting on your equity portfolio. Unfortunately, that's only half the story because, as you know, your bond portfolios probably haven't been giving you the income that you've seen or you've been used to throughout your lifetime. So what I want you to focus on here is that asset allocation in the middle there, and you'll see 100% return seeking at the top, decreasing in risk all the way down to 100% risk mitigating. Risk mitigating is what we think of as very safe bond-like securities. Return seeking is very aggressive equity-like portfolios, and then we have a mixture in between. So if we look on the right-hand side, what you're going to see is our projected median returns over the next 10 years. So think of this as this is what we think the indexes are going to do over the next 10 years. 100% return seeking, I've covered that on the last page, is significantly below the normal or the history of stocks. But if you look at the bottom, at the bond portfolio, 100% fixed income, man, that's really far below its historical average too. It's about 50% of what we've experienced over the past 30 years in the bond market. So when you add that up, no matter what type of allocation you are, there's a significant return gap. And we think this is a huge problem for everybody. Not only that, on the left-hand side, because of the type of environment we are in, where we have, again, low interest rates, rising interest rates, and growing inflation, your probability of, or your volatility is also going to be increased. And we show this on the left-hand side in a way where we're saying the probability of a 20% peak-to-trough loss over the next 10 years. Normally, for an equity portfolio, we peg that at about 50%. Now we're saying it's 61. For a 60-40 portfolio, which is a lot of probably what the asset allocations are here in this room, that normally is around 8 or 9% chance over a 10-year period. Well, now it's over 17%. So we have this problem where we're going to have compounding low returns over a long time and greater volatility. So how do we solve for that? How do we close that gap? And how do we reduce the volatility in portfolios? Well, next, I'd like to welcome Greg Young up to the stage. As Greg Hext has mentioned, he's Senior Portfolio Manager in our Dallas office. He's also a CFA holder, and he's my friend. Greg Young, kind of. Come on up.
Thank you, everybody, for the opportunity to come and talk to you this morning. Greg, thank you for having us. We appreciate that opportunity. I think Dan did a good job of sort of laying out the challenges of the conundrum that we have. But as we think about it going forward, I just would like to get a sense of the room. Unless you've been in a coma lately, you probably have noticed that the stock market has become very, very volatile, right? It's not unusual to have 300-400 point swings up one day, down the next. In fact, I read somewhere that so far this year in 2018, we've already had 26 instances of the market moving greater than 1%, either up or down, compared to only 8 instances for all of last year, right? Last year, it would be very hard to top. But as we think about the context going forward, you kind of have to look from where we came. And everything that could possibly go right essentially did in 2017. What this chart is trying to illustrate, contrary to all of the experience, virtually all the experience we've ever had in the stock market, where you've had up months, negative months as characterized by those dark boxes, even in years that turned out to be good years, which is that far right column, the calendar year return, you always had some negative months until you got to 2017. That's that top row. There were no negative months. In fact, it goes back into late 2016 and continued into January of this year. And then along came February. We had a 10% downturn in the market. And that certainly was jolting And what we noticed in talking to clients is there was certainly a concern that somehow this felt unusual. This was abnormal to have this kind of volatility. Well, no, actually, it was the year prior, 2017, it was really the abnormal. Because for the longest period of time, another way to think about what I just showed you on the previous page is that you almost certainly are going to experience intra-year volatility. And I'm illustrating this. The bars on the top represent the calendar year returns for the S&P 500, and then those diamonds below represent, well, how much did stocks move from peak to trough, from their highest value to their lowest value at any point during the year. And certainly there were some extreme moves down, not surprisingly characterized by big bear markets, but even in good years, it's not unusual to have a lot of swings, a lot of volatility. So I guess my opening message is what we've been experiencing recently is kind of par for the course. It's probably something that we need to expect to see more of going forward. But my second message is that, as Dan alluded to, we don't think that this is necessarily a harbinger of something that's worse to come. Because from a starting point, the conditions are actually pretty good. Economic conditions, not just here but globally, are very good. There are a number of ways I could illustrate this. The chart's a little bit washed out, but this is measuring, when you look globally, how many countries were in expansion mode, relying on global purchasing managers indices. It's a high frequency indicator, has very good predictive ability. It's a good representation for countries that are expanding, particularly in the manufacturing sector. And if we could see that on that shading part last year, essentially every economy that mattered was in expansion mode. And not surprisingly here in the US, right? Anything above 50 is considered expansion. Now that's starting to slow a little bit. It would be unlikely to keep up the same pace that we've had going forward, but I don't think that's anything that's not necessarily setting off alarm bells. The backdrop is very, very good fundamentally. And when we talk to businesses, I bet if I went around and polled everyone in the room, probably get a similar sense. Most business owners that we talk to are feeling pretty good. Business is pretty good. Particularly when you talk to small business owners, that optimism spiked in the fall of 2016. Why? Well, surprise election, Donald Trump, make America great again, lower taxes. Things sort of went sideways with that optimism in the early part of last year, and then got a very nice boost. Why? Because of the passage of corporate tax reform. And even since then, the same survey has hit all-time high levels. So by and large, businesses are feeling pretty good about their situation, and why shouldn't they? Dan talked about earnings growth. Earnings growth actually started to turn around back in the summer of 2016, prior to the election, but then obviously got a nice boost coming out of that last year. And this doesn't even take into account the growth that we're expecting, that the market is expecting because of tax reform. The last estimate I saw from a bottom-up consensus for S&P 500 was something like 17% expected earnings growth this year. About 8 of that 17, give or take, just from the tax cuts themselves. Now that rate will start to slow as you move into 2019, and eventually, again, it's going to normalize. So at least here in the early goings, it's pretty much widespread manna from heaven across the board. The problem is that markets start to think about things aren't going to be as good, probably 6 to 9 months before the earnings growth starts to slow. But at least for the time being, things look pretty good. And underlying all of this, in terms of monetary policy, not just here with the Federal Reserve, but again in Bank of Japan, European Central Bank, monetary conditions are still broadly very accommodative. You'll notice a slight nuance on this page. The Federal Reserve, this is just essentially measuring the balance sheets of the central banks. the Federal Reserve, because that line started to flatten out and it's actually going to start to decline slowly over time as they tighten policy, shrink the balance sheet. But Japan and Europe are still in expansion mode. The European Central Bank will probably by the end of this year start, or at least announce, their own balance sheet shrinking, and then the Bank of Japan will be probably another year or two behind that. But what that is setting, another benefit that businesses are seeing, financial conditions are still pretty good. We already have rising rates. Let me take a quick poll. How many times since December of 2015, I believe, how many times has the Federal Reserve tightened the Fed funds rate? How many believe 4 times? 4 times. No? 5 times. A couple of hands. 6 times. It's a very smart group. 6 times. And yet, interest rates, while they have certainly risen off their lows, are still very low for the Fed being 6 tightenings into this cycle. Part of this has been helped by a weaker dollar. Normally you would see the dollar strengthening, that's sort of contributing to the tightening scenario, but that hasn't happened. It's really been more equity volatility that has sort of complemented the Fed's moves and is starting to tighten those conditions, but at least it's doing so from a very accommodative position. Now, there are a whole host of sort of dire scenarios that have been painted or talked about that could happen from maintaining very loose monetary policy for a long period of time. One of the ones that we hear frequently is that, well, the next bubble is going to show up on the household balance sheet. It was in housing specifically, but when you read articles, you talk about the debt situation of households here in the U.S., it's gone through the roof. That's true. You can see that on the left-hand side of this display. The average household balance sheet, the amount of debt that's sitting on there, is literally at all-time highs. But that's kind of to be expected 8 or 9 years coming out of the last recession. What's more important is that when you put that in perspective, as a percent, for instance, in the middle display, take that same debt level and base it relative to the size of the underlying economy. Well, now it doesn't look quite as scary. And even more important, on the far right-hand display, the average debt service, how much it cost each one of us to service that higher debt load relative to our liquid assets, to our income, is still at very low levels. Now, obviously, those lines will start to move up as conditions tighten, but again, long way from exerting a strong squeeze on the consumer, and that's important, right, because of the percentage of GDP that is generated by consumption and consumer spending here in the U.S. So we're not that concerned about that particular issue. Now, here's something to sort of talk about the good and the bad. This was a political issue and has certainly been talked about in a political context. This particular economic cycle that we're in right now, that started back in the spring of 2009, it's illustrated by this green line, marked 2008. In terms of duration, how long this cycle is, at the end of last year was already the 3rd longest economic expansion in U.S. history, post-war history. By the time it's all said and done, it'll probably go into the record books as the longest cycle of economic expansion in the country, but it has come at a cost that we're measuring over here on the y-axis, and that is that the amount of aggregate output, the amount of production, the amount of growth, you can tell by how flat that line is, has been right? It hasn't had nearly as much aggregate production, aggregate economic output. But there is a silver lining to that. What we talk about on the right is that it's really hard to see where that source of that next recession necessarily is going to come from. Outside of, and I'll talk about some of the likely options coming up, outside of policy mistakes, trade wars, the Fed tightening too much, but just from a fundamental standpoint, things overheating, it's not all that obvious. exactly where that is. We think that is one consequence or one outcome from that rate of growth being as low as it has been for so long. The takeaway from that is that perversely helps promote or at least continue to promulgate the length of that expansion, and that should be an unmitigated good. Now, Dan alluded to this. Returns, getting back to an investment context, returns in the liquid stock and bond markets next 5 or 10 years, not anywhere as good as it's been over the recent 5 or 10 years. It's still the case that stocks are pretty much the only game in town relative to bonds. You can see that with that expected risk premium on the left-hand side. But for a lot of investors, this is the conundrum. I'm not going to make as much as I have historically. What do I do about it? Some of those choices are pretty unpalatable. You can work longer, spend less, save more, invest more aggressively, perhaps. But you remember the last slide that Dan showed, if you want to push that risk up, you do so under the threat, at least, of a much higher likelihood of experiencing a significant downturn. That can be a tough trade-off for people. So, conditions by and large good. What could upset the apple cart? Well, there's a number of things. This isn't necessarily listed in order. We've already talked about how good earnings are. Problem with the street is that those forecasts of 17% this year, they almost always start to get pushed down as the year progresses. So earnings expectations will probably fade as the year goes on. Inflation. It's been a long time since we've had to worry about a resurgence of inflation. It's not our base case scenario, but there are a whole host of cyclical and structural reasons to expect that inflation is going to push higher. One of the cyclical expectations, because frankly we have a very tight labor market, very tight. 4.1% unemployment rate. By the time that troughs, it'll probably be something like 3.7, 3.8. It's been a long time since we've had unemployment that low, and we have started to see wage pressure start to move up. That, along with other catalysts, it would not be unexpected to see inflation start to tighten. U.S. economic activity particularly, things have been so good it almost leads you to believe that perhaps the most likely direction is that things are starting to soften, which they are. We're starting to see some indications that conditions are starting to soften somewhat. It's not raising too many concerns. We expected that rate of growth would be hard to maintain indefinitely, but we are starting to see some slowing down. A lot of it having to do with trade policy, starting to exert a slowdown effect. What about the benefit of corporate tax cuts, right? Early on, this year specifically, it's sort of equal opportunity for every business, every sector, every industry. It just sort of falls into the lap. But as you move forward, the competitive dynamics of different industries, think of retail just to pick on one, particularly those that are exposed to Amazon, for instance. The competitive dynamics are going to lead some businesses to sort of take those additional earnings and have to turn around and spend it, right, just to maintain market share. Maybe they lower their prices, they do something to try and maintain their position in the marketplace. Bottom line meaning it'd be less likely for those earnings to make their way down to the bottom line and fall into our lap as shareholders. Right? Banks are another area. It's very highly competitive, relatively low ROE. There's a lot of competitive pressures in that space where you would expect as time goes on, it's going to be less likely that the average investor is going to see those earnings fall into their lap. And then finally, I mentioned this is probably the more likely. Policy mistakes, either at the executive level or the Fed. I tell you, specifically with Jerome Powell, who's the new Fed chair, he may sort of rue the day that he got the position from Janet Yellen because it basically falls to him to try and pull off something that no Fed chair in the U.S. has ever been successful at doing, which is he has to engineer actually a raising of the unemployment rate, right? 3.7 is, that's just a bubble waiting to happen. So he has to engineer a slow, gradual increase in that unemployment rate, but not so much that it causes a recession. And that sort of balancing act, which is really the bottom line existence of what central bankers live to do, is extremely hard to pull off. Never really been done successfully. So the chances of going either side, either being too modest or more likely too aggressive, could certainly play a role here. Again, we won't say necessarily it's our base case, but inflation will almost certainly be the catalyst that we have to watch. So let me kind of go into the punchline here. To put it all onto one page, let's use the stock market as the S&P 500 at the top and volatility that Dan mentioned. Think of that as risk. Excuse me. So where we sit today, returns, asset prices have hit relatively, even with late volatility, sit at very high levels, and the risk accompanying that, the volatility, sitting at all-time lows. It's much more likely, as you can even see on this page, but especially when you go back in history, those lines will start to move more toward one another. They'll start to converge closer to one another. Why do we expect that? Well, equity valuations are still high, even after recent declines in the market. That earnings growth rate is going to start to normalize as time goes on, and obviously monetary policy will continue to tighten. That's a little bit of a headwind. So that would almost certainly impact stock and bond returns. What do we do about it? Well, there's still a couple of ways to circumvent this. It almost always involves a trade-off. What's your trade-off? We think that looking outside the liquid stock and bond markets, being willing to tie up capital for some period of time is a very good answer, but illiquidity is something that some can tolerate more than others. Or if illiquidity is not really feasible, then the other trade-off is probably being willing to be exposed to look much more different than the market with the attendant volatility that comes with that. Think of that as more of an idiosyncratic. I'm not betting on the come, I'm not betting on the rising tide effect. I actually need to pick the boat that I want to be in. Think of it as a more idiosyncratic bet. So the way I would dimension this, and these are my last three slides, and I'd be happy to open it up for questions. Let's sort of take it by what's the goal as an investor. A lot of folks, it's yield, it's income. This is particularly challenging because we're starting off with sort of twin points of pain. We've got interest rates broadly that are still very low, so the yields starting off are pretty low, and interest rates are going to migrate up over time, exerting downward pressure on the returns of those bonds. So it is true that we expect interest rates will rise, but the good news is that that path of normalization, barring an inflation shock, should be very well telegraphed, pretty well understood by the market, and is probably going to be a relatively long path. We're not going back to very high rate levels, but this is something that will persist. In the bond world, and we already showed you this, we still think that bonds, and I'm talking right down the middle of the fairway, diversified investment grade, are still positive, but just very, very low returns. And particularly in the more risky parts of the liquid bond market, think long horizon, long maturity, long duration, or lower credit, that could be particularly problematic. Those are much more exposed going forward. What would be ideal would be to find something that doesn't have the same exposure to rising interest rates, or actually benefits from rising interest rates. So to go from a fixed rate investment to floating rate. As rates move up, your yields go up in tandem. It almost certainly is going to require looking outside the usual suspects. It could be in sort of out-of-the-way sectors of the market. One of the few areas in the bond world, in the securities markets today, that is still early enough in its credit cycle that underwriting standards haven't gone lax, is actually in the securitized space, in the mortgage space. Residential, some commercial, a little bit on the consumer debt side. Still early enough in the cycle, underwriting conditions are pretty conservative, and yet the yields are pretty attractive. That's one option. Or in the illiquid, actually not in the bond market itself, but more in the lending space, the alternative credit. Going in and providing credit alone where the banks, the traditional providers of credit, are not as active for a whole host of reasons. So we call that private credit. Those are sort of your two options, and the returns can be very good. It comes at the cost of potentially higher volatility in the case of mortgages, or illiquidity because you're loaning money, you're tying money up for some period of time in alternative credit. What about growth for equity options here? Well, again, stocks and other aggressive asset classes, it's just been a nice tailwind for 8 or 9 years as interest rates been declining, the Fed was supportive. But even as that is coming to an end and markets will face challenges going forward, over the course of that long 8 or 9 year period of declining interest rates, it still was the case that there was a great deal of dislocation going on in markets within sectors. So it could be the case that those opportunities are in very specific sectors, like energy, or in microcap banks, as Dan talked about, or it could be geographic, not focusing so much on the U.S. large cap space, looking perhaps more at frontier markets, or even in places like Europe, not as much in Europe as it was a couple of years ago, but in foreign markets specifically. So sectors, geographies. Then the third way is really by more portfolio construction, how you're building your portfolio. In other words, if we think the returns are going to be low and accompanied by high volatility at the market level, maybe we don't want to look like the market. Maybe this isn't the time. Despite what everything looks like in the rearview mirror, it's just been one big long beta trade. You just needed to be on board. Now you don't want to be. This is about looking different, picking your points, picking your battles with a more concentrated portfolio. It's strangely enough an ideal environment for using research to find those mispriced companies that for whatever reason have their stock prices, their public prices don't reflect what their intrinsic values are underneath, and then take very concentrated positions there. And then finally, from a diversification standpoint, if it's really not so much a yield seeker, I don't want maximum growth, but I just want to diversify, preserve what I have. The normal go-to solution is, well, I need to have more cash in the portfolio. And it is true that cash is paying more than it has previously. Previously it paid you nothing. So at least I'm getting 1.5 in sort of typical money markets, but even that is really not going to keep up with inflation. Cash isn't the right de-risking option. The right de-risking option is to look for something that has sort of independent streams of returns that are just not correlated with what's happening in the stock and bond market. In fact, if it can do so in a way that is diversifying and is not, tightly wound to what's happening in the broader markets of the economy, even better. So low correlation. There's a number of options here, but probably the easiest one to think of would be stuff that sort of falls into that market neutral camp. What does that mean? Well, some people think of it as hedge funds. That's kind of a loaded term. I prefer market neutral strategies. Market neutral would be looking at equities, for instance, and deciding that you want to go long Google and you want to be short IBM, that you want to be long Apple and short Facebook. Those aren't ideal trade-offs, but something where you are taking advantage of prices that you expect to rise, at the same time offsetting as best you can what you expect to be falling prices. And in the process of doing that, if everything sort of lines up and you know what you're doing, you can substantially, if not completely, reduce or eliminate your market exposure. That's obviously what we're trying to do here. We're trying to minimize the market as the source of both return and risk. We want to reduce it down to individual security selection. Market neutral type strategies are a good way to do that. All right. What questions, concerns, rebuttals, pushback? Would love to hear any kind of feedback, what you're seeing in your own businesses, anywhere which you agree or that you disagree. Yes, sir.
There was a product that I read about that I have found very, very little information on, and I wanted to get your comment on it because it almost seems too good to be true. In the mortgage investment space, it was a mortgage-backed strip where where they have stripped away the interest-bearing portion of the investment and allowed you to invest in only that. And it seemed almost too good to be true, since we seem to be at the lower end of mortgage interest rates. It seemed if it was a legitimate product, it would appear to be a good investment. I can't say much more because I only read one article about it and could find very little additional information. Are you familiar with that?
Yeah, the strips are a way exactly like you described, where the investment bank in this case is taking a stream of cash flows coming off of that mortgage and tranching it, right? Separating out the coupon or the repayment amortization and making that one set stream of cash flows. And then principal repayments, price appreciation could be another set of cash flows. Without getting into the mechanics or the appeal of that, I would agree that the backdrop, generally speaking, in the mortgage space, as I just said, particularly in residential, to a certain extent in commercial, there are some appealing aspects to it. It's not necessarily an endorsement of that sort of slicing and dicing, which you're referring to. It's sort of very much of a buyer beware. What I will say is that what makes this part of the market, particularly the U.S. residential, and I do mean housing, what makes that attractive is that the way that the U.S. housing market is financed today is different, in fact, fundamentally different than it was prior to 2007, 2008. Yes, Fannie Mae and Freddie Mac, the government is still a very large player, but they don't absorb 100% of the risk anymore. That was obviously the learning coming out of the downturn. So the way this market has evolved is much more of a hybrid sort of private capital, think Bernstein, for instance, and the government. The government, through the agencies, provides liquidity, stability, and really a backstop to help underpin values in that marketplace. But they don't take first dollar risk. That's what the private sector, that's what private capital does, which frankly, we're in a better position, honestly, to come in and do price discovery and figure out how much that risk is worth. So that sort of hybrid structure, what is called a credit risk transfer, it's not a strip, but that CRT is really now the backbone of the market. You still have a lot of legacy mortgage-backed paper that's going to take a long time to sort of roll off, but virtually all of the new issuance now going forward is in this hybrid structure. That is the security that is much more appealing. There was another question? Don't be bashful. There's no dumb question. Yes, sir?
Okay, so as a personal investor, a lot of the index funds have created a passivity attitude for many people. So are you suggesting moving forward that the active investment to folks is a more interesting, contrary view than what the hedge funds?
Yeah, let me paraphrase your question just so everybody could hear it. Are we saying that index investing has obviously been very, very popular? Are we saying in effect that that's not going to be as popular or as successful going forward? Close enough? That active management, picking stocks as opposed to just picking the boat, instead of relying on the tide? Yes. Short answer is yes. Now, that's self-serving. We're in the stock picking business. We actually do run a pretty substantial book of passive assets. So technically we can be agnostic. But the interesting thing, in fact, I think I have a slide on this. When people ask about active, passive, the problem is on either side of that debate, the way it's usually positioned is it's just an open and shut case, right? It's just, well, passive always wins. Or active always wins. The honest answer is these things go in cycles. It just so happens that since the downturn in 2008, look at the bars to the far right, this is measuring the degree that the average large cap core equity manager has outperformed, or in this case, underperformed the broader market. It's just been a string of years where active stock pickers in the US have underperformed the index. But really, the large part of that, the largest reason for that is because it was an environment that was tailor-made for what we call sort of the beta trader, the index, the market overall. Interest rates were falling. Market returns were very, very low. Volatility was extremely low. There were more managers coming out of the previous cycle that were trying to pick stocks. And you had to get down into statistics. There was very little dispersion between how individual stocks were performing. It really was a rising tide effect. And so as an example, or as a result of that, the correlations among assets were very, very high. Far more active investors. In other words, the conditions were such that it was just all the planets aligned to make that an incredibly good environment for passive, largely and mainly because the Fed, by driving rates down to the floor in highly unusual fashion for the Fed, swamped every other consideration. Macro drove everything. But just the history, I could just stick with that one page and show that these things move in cycles. So if we think going forward, on the left-hand side, do we think rates are going to be higher? Do we think equity returns are going to be more modest? Is there going to be, just look at all those boxes. Yes. So the argument, or our view on that, has to do because we think the conditions are going to be very different.
Hate to cut you off.
That's all right, I'm used to it.
But we try and make sure, we could all probably stay here for another hour and ask questions. We try and make sure that we cut it off at 9 o'clock. We know a lot of you have a very specific schedule and stuff. I'd like to thank you guys for coming today. Thank you so much.